Welcoming a very special guest, Jayakumar, MD and Group CEO of Prime Securities, joins us right now on the show. At some point of time, Jakes, we got to talk about the multiple things you're doing on the business side as well, because I hear a lot of stuff that you're doing. But for today, we'll stick to the markets. And good morning, of course. How do you see the uptick in the last couple of days, Jakes? I mean, because there seems to be a broad-based move that happened yesterday, and people are starting to turn a bit constructive. Are you?
I've been extremely bullish. In fact, one of the things, at least even as of this is not looking back and saying that, this is something that even on commentary in the last week, 10 days, I've been saying that when we turn, it will be an aggressive V-shaped, almost a rocket-like takeoff. Because so many people, I mean, so many HNIs, so many traders, so many overseas FIIs, hedge funds, there's been mass capitulation that's happened in the Indian markets. And really what's happened is this has to be seen in the context of what's happening in the rest of the world, where 3 months ago, the only trade in life was to go along the US markets, was also to do a tactical buy on China. Now with tariffs being imposed on China, problems in most parts of the world in terms of bilateral trade agreements with the US, the only country that seems to, keeping fingers crossed, but I think will come out unscathed and probably significantly better off is India. And I think if you see it, I can almost go to the extent of saying that Trump is almost presiding over the demise of the trust that people had in the US markets and the US policy making for so many years. The same kind of trust deficit that befell China and made people go away. With the consensus buy that happened 3 months ago and everybody rushing in, all money rushing into the US, that's taken a complete U-shaped sort of turnaround, and there's mass money that's been flowing out. The Trump rant, if you will, has actually woken up China into creating the biggest ever fiscal stimulus in their history, has woken up and reunited the European Union in terms of getting them to spend. So whether it's in terms of people, countries getting together, or in terms of just trade barriers, etc., the one country that's not been singled out and which is quietly negotiating its position, which I think over the next 2 weeks will be very clear, is India. And therefore, I believe both in terms of money flow and in terms of the outcome of the tariff war or the Trump rant, and the fact that the dollar index coming off is a clear indication of where money is moving. And I expect a very sharp decline in the dollar index over the next 6 months, helping emerging markets, specifically India, where both in terms of manufacturing and in terms of exports from here, I think we're talking about a sweet spot. And from a technical perspective, the market needed an excuse for corrections, which has come through. And therefore, a combination of all this, I'm extremely bullish, and therefore the markets have to jump and move up very aggressively in the short run so that people can look back and say they missed out on the bottom. A bottom is not one where the world as a whole walks in, buys and makes money. It's where a few people get in, and the world at large, because of the tax and other reasons, that the seasonal factor in India, people have actually will look back and say that we missed out on a very, very strong bottom at 21,800, 22,000.
So you've already called it, Mr. Jayakumar. Good morning to you. And I'm curious. So therefore, based on what you're saying, so many factors working in favor of the Indian equity markets, and indeed the investor that has stayed put, that has continued to deploy and buy on dips instead of sell on rise, right? So therefore, where do you see the biggest opportunities at this juncture? We've been consistently talking about banks as being relatively attractive in terms of valuation, but several more pockets have also emerged over the last 3 months, 4 months, because of the frenetic selling that we've seen.
Sure. I think when the tide goes down, all ships go down, as it were. And today, it's not a case of all boats rising. I think the tech sector still has problems, Alex. I think there are problems in terms of the way AI continues to disrupt, whether it's the low-cost, arguably low-cost DeepSeek model, or it's the, invest till you go blue in the face kind of OpenAI, Anthropic kind of model. Whichever way you look at it, there's a lot of money chasing a space which is clearly disrupting existing businesses, whether it's the legal space, whether it's the medical space, whether it's the finance analyst community. I think there's going to be mass disruption. And therefore I'm still unclear what the impact of the manpower heavy IT services business in India will do. So that could be weighing pretty negatively on the sentiment as far as the index is concerned. There could be a bounce back, a sort of reflex rally that takes place, but I think there are headwinds ahead business-wise as far as the IT is concerned. But compensating that could well be the financial services space, and which we've talked about, especially banks and private sector banks in that. And the other space, private sector banks that were beset by problems of, let's say, the MFI or the credit card exposures, if you will, all that has changed with the government spending having stepped up dramatically, RBI having eased liquidity. So the money flow in the system, back-ended as it might be for this 24-25 fiscal year, has actually helped in recovering a lot of these spaces. And I think recoveries, collections, etc. will improve quite dramatically into Q4 and Q1. That's as far as the banks are concerned. But the space that really could be a big winner, especially in a country like the US, which is crying out for low cost inflation to be under control, which all of that gets threatened with tariffs. The one space that could be benefited, both in terms of the low cost nature of its exports out of India, as well as the fact that we have a relatively better off vis-a-vis tariffs in the rest of the world, that's the pharmaceutical space. I think generics will boom, and generics boom, which we've seen in the last few years, has culminated in the US talking about almost 395 drugs. It's a historic high in terms of the number of drugs that are in short supply. This figure came out as of December end. So the 395 drugs, the fact that you can't produce in what is essentially a high-cost manufacturing economy, that's the US. The US has been known for consumption, never for manufacturing prowess. And the space that actually compensated for all this has been the tech-heavy or the innovation-led growth, if you will, in the US, which also is being threatened by China and the sort of low-cost nature of the innovation. So keeping this in mind, pharmaceutical exports out of India will be even more benefited compared to exports out of China, etc., into the US because of tariffs. And when the dust settles and the cobwebs are cleared as of first week of April, in terms of the bilateral tariff arrangements with the US, I think you'll find that the pharmaceutical sector will have a massive headwind, a massive tailwind, and a massive clear stretch to look forward to. So the runway clears for pharma. Tech is still a problem. The space that is unaffected by all this is, is the local banking and financial services space, not so much the NBFC space, which I think will consolidate more and more into the banking, especially private sector banks. And the one other space that I want to talk about is if the dollar index collapses the way I'm envisaging, which actually is the only way that when money moves out of the US and they have to become more competitive, let's say out of exports out of there, probably the collapse of the dollar index, and we could see a 10-15% drop over the next 6 to 9 months, could result in metals and commodities being really benefited in a big way. And that's why that space, which is under-owned, the metals and commodity space, could be big beneficiaries into the next 6 months.
Okay. Jakes, the other key point would be, because you look at the global picture so closely, and you spoke about the dollar index, so on and so forth, if the last dollar were to move eastward, the current pools of capital for the last 5 months have gone towards China predominantly. Europe is emerging as an alternate. Does India, because of the valuations, become an attractive one? Because you speak to some FIIs, we spoke to one yesterday and they were saying they are hunting in India in the mid-cap space as well. Do you sense that global money is now making or fishing in the Indian pond for bargain buys?
No question about it. These are seasonal flows. We've had almost 2, 3 years or 4 years of uninterrupted outflows. At some point in time, whether it's in terms of valuations or just exposures being much lower than what is desired, people may come back here. Why people prefer mid-caps, etc., is that people feel that the over-ownership in the frontliners could be a dampener. My own sense is that markets will move up. Sectors like financial services and pharma will lead the way forward. And from that point of view, whether it's foreigners or, I have not been spooked necessarily about the fact that foreigners have been selling. I think markets ultimately start moving up much more when there's a lack of selling rather than buying. So by the time the buying comes in, we still have, as I said, many quarters to go. Maybe it's still 3, 4 months, 6 months before the actual gush of money comes in. The FIs have been coming in, you must note, into the IPO market. But there also it's been a case of coming in and having more of a 6 months to a year's play. The kind of sectoral focus or the sort of secular focus on things like HDFC Bank, ICICI, that's reduced over a period of time. So you see, even as of today, frontline selling continuing in some of the large cap names, especially names like Reliance and names like the big ICICI, HDFC. So the moves there could be muted, but a lot of new funds coming through may look for the mid cap and small cap space. I mean, mid cap more than small cap. And of course, the mid cap definition also has changed, but the 5,000 crore plus kind of names will probably attract money. And there people may see the bang for the buck a lot more because of the under-owned nature of those spaces.
I'm just wondering, because you've called the bottom, and we've seen quite a few of these capital market plays, of course, for different reasons as well. You're talking about BSE that has borne the brunt of the change in the treatment of derivatives and the way that things have gone there. But several capital market plays have lost favor, have lost ground. Of course, one would argue that in the past few months, they have reached uncharted territory and therefore valuations were egregious. But assuming that you see a spurt of buying, you see foreign institutions come back, hopefully in droves, and supporting the bottom, would you say that a few of these capital market plays become attractive once again?
Well, only one small correction in what you said. I don't think foreign investors are going to come in droves to support a bottom, because I think they will come in when the momentum builds up on the higher side. They don't come in bottom fishing in my experience. So that apart, the capital market plays, the reason I like them is those that have got affected are those who are in the brokerage play and those in the IPO play. The IPO and the brokerage spaces have been hit in recent times, but the more secular themes like wealth management or the few plays that exist in investment banking, and I must say, give you the disclosure that the company that I am part of, Prime Securities, also is in the investment banking space. So those which are niches in the investment banking space, in wealth management, etc., which are granular and the annuity kind of flows, are not as badly affected. In fact, there I feel those who are in the restructuring and other advisory spaces are actually benefited because the kind of need for those services even more now. But those in the brokerage and the IPO space, which were hot money, and where there was large amounts or large pools of churn in those two spaces, they have been affected because the volumes have actually pretty dramatically come off in the last 6 months.
Okay. Okay. So we've not spoken to you. So you've spoken about several sectors already, and you spoke about pharma, you spoke about tech. I'm wondering about the platform company, because here as well you've seen some erosion in value, and there was an interesting note that said that perhaps the next 2 to 3 quarters, as expected, is going to perhaps be a little soft for companies like Zomato, companies like Swiggy. But of course, if you're building in positions, you would build for the much longer term. Would you buy into these?
At this point in time, the options are plenty. I mean, to my mind, while the valuations have come up, but some of these are bull market plays where people take a call in the future. Consumption has got hit, no question about it. But that consumption at the price points that some of these platform companies operate, I don't think leave much margins. Forget free cash flow. I don't even think there is operating profits in many of these businesses. So I'm still a person who seeks, of course, the fall has been such that there could be reflex rallies. These could go up, 10, 15, 20%, and nobody would be any wiser in that sense. But are there cash flows that support this? I'm still, searching for those. Many of the platform companies have expanded to other areas. They've dropped their moats. People in the beauty and personal care, for instance, have dropped their moats and gone into fashion. They've gone into other sort of verticals. And I'm a great believer in the fact that moats need to be exploited. So while there may be reflex rallies, I think that those who have diversified and gone into other areas just to be able to chase GMV, I think are still set for us.